Today we are going to be taking a look at Zscaler, specifically the most recent earnings report, which resulted in a 31% drop, which then resulted in multiple securities lawsuits, and finally Zscaler is being removed from the nasdaq, and we need to talk about what that means. After that, we are going to pull up the chart and see if we can find any sort of options trade on this thing, or if it's a hard pass. And is this the bounce of the century or a falling knife? Let's get into it. You guys, Zscaler, the chart, it is so ugly. Let's pull up the chart. Look at the chart of Zscaler. But every ugly chart has a story. And Zscaler's story has 3 chapters. Chapter 1, May 27th, the stock lost 31% in a single session. That is right over here on this earnings report. Chapter 2, guys, that collapse immediately triggered multiple securities lawsuits, some that are already moving towards active filing deadlines. And Chapter 3, guys, the NASDAQ announced Zscaler is being removed from the NASDAQ 100. And this becomes in full effect on Monday, June 22nd. This will force every QQQ tracking fund to liquidate its position before the open on Monday. So we have a 31% crash, active legal pressure, and forced index selling. Normally, when those ingredients show up together, traders start hunting for an oversold bounce. So let's start with the event that changed everything. On May 26th, after the close, Zscaler reported fiscal Q3 2026 earnings. And if you only looked at the headlines, the report looked perfectly healthy. Revenue came in at $850 million, which is 25% year-over-year growth. Non-GAAP operating margin hit a record of 23%, and annual recurring revenue reached $3.5 billion, also up 25%. At first glance, guys, nothing about those numbers suggests a stock that should lose nearly a third of its value overnight. The business wasn't broken. The problem was what came next. Management guided Q4 revenue to $875 to $878 million, which is roughly 22% growth. Now that's reasonable. But then investors got their first real look at fiscal 2027 expectations. ARR growth was projected at just 16 to 17%. And that's where the market broke. Because Zscaler wasn't being valued like a 17% growth software as a service company. It was being valued like a mid-20s growth company. The street was looking for acceleration, or at a minimum stability, and instead management showed deceleration. And premium software multiples don't survive deceleration stories. Then came the second issue, guys. Free cash flow margin guidance was reduced from 26.5 to 27% down to 22.8 to 23.3%. Slower growth, lower cash generation. And then one more development, right? They just kept hitting us with this stuff. Management disclosed the departure of 2 senior sales leaders. And in enterprise software, sales leadership is not a minor detail. These are the people managing customer relationships, renewals, bookings pipelines, and large account growth. And when they leave, investors immediately start questioning future execution. Management called their guidance approach prudent. Translation? They're not fully certain what the disruption looks like yet. The market heard all of it at once, and the response was immediate. The stock fell from roughly 184 to 126. A company worth roughly $25 billion lost around $8 billion in market value in a single session. Guys, it was an earnings beat. And to have that type of massive move, and this, guys, is the foundation for everything that we are discussing today. So now that we know why the stock crashed, right? The company isn't broken. The products still work. The customers are still there. But understanding a business and understanding a trade are 2 different things. Because what happened after the earnings report is where this setup really started to deteriorate. So a 31% collapse over here again, this big gap down, right? This creates consequences. And Zscaler accumulated them fast. First came the lawyers. Within days, multiple firms announced investigation. Pomerantz, Farkey & Farkey, Johnson Fistel, Shaw, the Gross Law Firm. And this distinction matters. Some firms are merely investigating. The Gross Law Firm is already advertising a deadline tied to a class action complaint. That's no longer we're looking into it. That's active legal exposure. And practically speaking, That creates an institutional overhang. Compliance departments don't love increasing exposure to companies navigating active securities litigation. And when institutions hesitate, recoveries become difficult to sustain. You get reflex rallies, you get short covering, you get dead cat bounces. But sustained sponsorship becomes harder. Then came another leadership change. Raj Judge, EVP of Corporate Strategy, resigned effective July 31st. That brings the total to 3 senior departures in a relatively short period. 2 sales leaders, 1 strategy executive. Maybe coincidence? Maybe not. Either way, investors are paying attention to this. Then confidence cracked on Wall Street. Okay, BTIG removed Zscaler from its first half 2026 top picks list, downgraded the stock to neutral, and removed its price target entirely. And that last part matters. Lowering a target says visibility has deteriorated, but removing it entirely says visibility may no longer exist. BTIG cited competitive pressure from Cloudflare and Netscope and expressed concern that market share dynamics could remain difficult for the next 6 to 12 months. And to be fair, most analysts still maintain buy ratings on Zscaler. Consensus targets range from roughly 155 all the way to 335 bucks. But BTIG's concern wasn't about one quarter. It was about structural competition. And structural concerns are harder to dismiss than temporary disappointments. Then the third catalyst. Last Thursday, the NASDAQ announced Zscaler will be removed from the NASDAQ 100 before the June 22nd open. This isn't an opinion. It is an index rule. Zscaler had fallen from a 52-week high of 336 to roughly 124 bucks a share. That is a decline of about 63%. The market cap on this contracted enough that it no longer qualifies to be included. And this is why traders care, because more than $800 billion tracks the NASDAQ 100. And every passive vehicle tracking that benchmark must sell Zscaler. Not because of a view and not because of the fundamentals, but because the rule book says they have to. That is forced supply, mechanical liquidation. And under normal circumstances, this is where bounce traders get interested. But when forced sellers finish selling, prices often recover. And that's where the Zscaler story becomes different. This isn't a healthy company experiencing an index shuffle. This is a stock already dealing with slowing growth, reduced cash flow expectations, executive turnover, legal scrutiny, and analyst uncertainty. And guys, legal scrutiny is enough for me to not touch a stock, right? Anytime lawyers and legal processes are involved, I personally stay away. And this is not financial advice, but anytime something legal, a legal cloud overhanging the stock, I just don't touch it. So the NASDAQ removal didn't create the problem. It just amplified what was already existing. So guys, now let's look at the options chain, because this is where the market stops telling you what happened and starts telling you what it expects next. And what I see here is an opportunity. It is uncertainty, and it is expensive uncertainty. So I'm going to pull up TastyTrade, and if you've never used TastyTrade before, it is the premier options trading platform out there right now. There's a link down in the description. It is a free download if you would like to give it a try. It is what I use to analyze all my options trades. And before we look at the chain, guys, it is important to separate the company from the stock, because those are not the same thing. Zscaler remains a legitimate business. Revenue growth is strong and margins are strong. ARR is strong. The company still serves enterprise customers. Its zero trust security platform remains relevant, and AI Protect continues gaining traction. The bear case isn't bankruptcy. The bear case is valuation. And a company expected to grow 25% deserves one multiple, but one expected to grow 17 deserves another. The market simply repriced that reality, and that is a very different conversation than saying the business is failing. So guys, here we go. Let's start by pulling up the weekly chart, because that's the entire technical framework. And right now, I don't see a base, right? I do not see a base forming. And I'm going to switch this over to the weekly. I had it on the 4-hour. Right? There's no base forming here. And we don't see any accumulation zones or a multi-week stabilization pattern anywhere. Every bounce attempt has been sold. And guys, we are right now at fresh lows below like what was the weekly 3-year low. So if we have to go out to the 10-year, right, the 10-year monthly chart, and this is what I established right here. This line at 90 bucks. This is a nice swing low, but we had to go out 10 years back, and this is from 2023, right? The other low we have over here is from the 2020 COVID low. So guys, until this stock can spend multiple weeks holding a level and printing higher lows, the chart offers no evidence of a sustained recovery. And honestly, I don't know if this thing is going to come down to, 90, or if we're going to come all the way back down to the COVID low. When you have litigation hanging over a stock, everything gets thrown out the window. Okay. So if we're completely just looking this technically, okay, this what is it, 113, 114.63, somewhere around there, that's the level that matters. Okay, that is the most recent swing low. If we lose it on volume, right, then we are looking at the $90 level, which I said. So now let's pull back open TastyTrade and talk about the options chain. And guys, this is what a professional stay away setup looks like. So if we look at the IV rank here, it is 45.4. That means we have kind of elevated volatility. And notably, it's not elevated because of earnings. Like, earnings already happened. The next report isn't until in September, roughly 85 days away. So the premium is being driven by uncertainty, and that's what we need to realize here. This is legal uncertainty, leadership uncertainty, growth uncertainty, index removal uncertainty. Okay, the market is not pricing an event. It is pricing a collection of unresolved risks. And that creates a problem for both sides. So call buyers are paying elevated premiums that require significant upside, right, just to break even. And put buyers face the same issue. And if we look at the one standard deviation, actually we're a little heavy to the call side. A one standard deviation put trades at an 8 delta, where a one standard deviation call is trading at a 21 delta. That means you're paying more. They think there's more upside right here. I'm not even sure, right? Institutions, they're looking for downside protection, but right now it looks like there's more people leaning towards the upside on this. Maybe they think we've hit low enough. Maybe they think some things are starting to resolve themselves. I haven't seen that evidence yet. So the result here, guys, we got elevated IV, no catalyst, no technical floor unless we go out to the 10-year chart. And that's the exact combination that creates an illusion of opportunity, right? I'm going to call it an illusion of opportunity without an actual edge. So guys, take a screenshot of this August 2026 chain, note the IV rank, note everything. Note that we could trade this, right? If it was another company, we could trade this. But because of what's hanging over Zscaler, the legal uncertainty, the leadership, and everything we just discussed, I am staying away. I'm not even going to suggest a trade on this. So now let's talk 3 scenarios for Zscaler, right? As a company, we've got a bull case, right? The legal situation would fade away. Management would hire a high-profile sales leader. September earnings come in clean. Growth reaccelerates toward 20%. The stock establishes a floor, between 115, 125, and gradually recovers. Possible? Absolutely. But likely in the next few weeks, not without several things going right first. So the base case, guys, is a dead cat bounce. Forced QQQ selling ends after June 22nd. Shorts would take their profits. The stock could rally 5 to 8%. Momentum traders would pile in. Then the underlying concerns reassert themselves. The rally would fade. The realization would come back to be like, oh, our leadership is not what we thought it was. Or, the litigation is moving forward. There's an issue here. We might get sued. We might lose. We might have to pay a big settlement. In that case, Zscaler would drift back down towards the 114 area, and it would probably, kind of stay there. This is probably the most structural probable outcome. And the bear case, guys, we got to talk about the bear case because trading stocks and options is all about managing your risk. This would be the class action lawsuit would expand, and additional executive departures would emerge. Sales disruption impacts Q4 execution, and the stock loses that 114.63 and goes all the way down to that $90, 85 to 90-ish range, which we saw in 2023 on the 10-year chart. Growth deceleration proves persistent rather than temporary. They can't make as much money as they were. They're not growing as fast, which would make the multiple go down. That makes the stock price go down. This is the outcome implied by the current put pricing. So when institutions consistently pay up for downside protection, it's worth paying attention. So guys, here's where I land. I understand the temptation here. A 31% crash, a NASDAQ 100 removal, class action headlines. That's exactly the kind of setup traders instinctively want to fade. But successful forced selling trades require one condition. The forced selling has to be the main problem. For Zscaler, it's not. The company is simultaneously dealing with slowing growth, leadership turnover, legal uncertainty, and deteriorating technicals. That is too many unresolved variables for me, right? I am not going to touch this thing right now. But for me, three things would need to happen. We would need to get legal clarity. We would need a confirmed floor on the chart, and a catalyst would need to change the narrative. Maybe a major hire, maybe a clean earnings report, maybe a renewed analyst upgrade cycle. Something tangible to say, hey, things are turning around. Until then, I am just going to watch this thing and not trade it. If 114.63 on the chart survives after June 22nd, right, that's the first evidence sellers may finally be exhausting themselves. But if it doesn't hold, the bear case starts gaining credibility very quickly. So guys, the lesson here isn't really about Zscaler. It's about process. Not every broken chart is a setup, and not every dislocation creates opportunity. Sometimes the highest probability trade is simply waiting. And guys, there are literally hundreds of trades that you could make per day. You don't need to force a trade on a specific stock just because you like it or you don't want to go look for something else. On the TastyTrade platform, it is so easy to sort by stocks with high IV, right? Find a setup, find a chart that looks promising, right? It looks like a sound, high probability trade, and execute the trade, right? If there's anything that stands out on a trade that makes you question it, just move on. Just move on from don't force trades. I hope this helped. I hope taking a look at Zscaler from beyond the NASDAQ exclusion and looking at everything that goes on with the company helped you make a decision on this trade and how to analyze a company before you start putting money into it. My name is Luke, and this is the Option Bomb, and I'll see you in the next one.